Okay, so let's get started. So welcome to today's session. So pin 1BZ, let's just go through first. Let's go back to the list of topics that we're supposed to cover. So for fin 1B, let's go through the list of topics. So chapter 1 up to chapter 7, I assume you covered that for fin 1A. So when you did fin 1A, you did cover chapter 1, chapter 2 up to chapter 7. So the problem with accounts is that some of the things that you did for fin 1A, they are also going to be applied in fin 1B. So as we learn through these courses, especially for the accounting field, you do need to grasp each level because it builds up to the next level. So what you're going to do for fin 1B, it can also build up to fin 2A. So some of the concepts you might have done, will again revisit them. So chapter 5, you did that. Chapter 6, trial balance and bank reconciliation, I assume you did that. So if you have any issues or if you have challenges that you're facing for these chapters that you have done in fin 1A, you will let me know. So chapter 7, that I assume is the last chapter you did. So chapter 7, that's preparation of the financial statements, the income statement, and the statement of financial position. So for fin 1B, started with the financial statements again, but so for our first session, it was on the financial statements, but now looking at adjustments. So for those that missed the first sessions, please let me know so that I can send you the recordings. Okay, so chapter 8 looks at the cash flow statements, the financial state preparation of the financial statements and the cash flow statements. Chapter 9 looks at the control accounts and the incomplete records. Then chapter 10, so we are supposed to cover chapter 8. We are supposed to cover chapter 9. We are supposed to cover chapter 10, that's the non-profit making organizations. We are also supposed to cover unit 11, that's depreciation and provision for bad debts. Unit 12, stock valuation and ratio analysis. Introduction to limited companies. So what you're supposed to cover is a bit broad. So we need to make sure we do move and also please do revisit what we have done so that at least we don't spend a lot of time on one area. But please, if need arise that we should go back to some of the things that we did, feel free to let me know. Okay, so in today's session, I understand quite a number of you joined in. So we'll go back to what was covered before you joined. But for now, let's get moving so that at least we can cover Zirigumberi as well. Let me just confirm the last thing we did. So the last thing we did was on manufacturing account and non-profit making organizations. So now I want us to move to depreciation and provision for bad debts. So let's talk about depreciation and provision for bad debts. So depreciation and provision for bad debts. That's today's discussion. Provision for depreciation. And Provision for bad debts. So today we want to talk about the provision for depreciation and the provision for bad debts. So before we get to talk, or before we get into detail with these, if we are talking about depreciation, the depreciation, what is depreciation? So provision for depreciation and for bad debts. The first thing is to understand what do we mean by depreciation. So just a moment. Okay, let's proceed. So provision for depreciation and provision for bad debts. So let's start with the term depreciation, because we might have covered it before, but you should know that assets, if you are to acquire non-current assets, that is, my assets are not in the business for a long period of time, their value does not always remain the same. The value of the non-current assets is likely to reduce over time. What can cause that value to reduce? It could be we are using the asset, number one. It can also reduce because of, so if you are using the asset, we call it wear and tear. So the value tends to reduce because of wear and tear. Then also the value can reduce because of time. If you buy a brand new motor vehicle and you just park it in the garage for 10 years, you cannot sell it in the same price. So even if there was no wear and tear, but the value can simply drop because of the time factor, because now it's now outdated. There are new versions which are in place. So the non-current assets or the fixed assets, with time, they reduce in value. So we call that depreciation. So depreciation, we say, is the systematic allocation of the depreciable amount over the life of the asset. So it is the allocation of the depreciable amount over the life of the asset. So depreciation, we are allocating the depreciable amount, or we are allocating the cost over the life of the asset. But in simple terms, we are saying the asset is being used, so it's reducing in value. So the amount by which the asset is lost to value, that's the depreciation. Now, let's move on. So depreciation in the business, it's an expense. Depreciation in the business, it is an expense. So depreciation is an expense in the business. So if you are accounting for depreciation, it's part of the expenses in the business. Or let's rather modify and say depreciation for the current year. The depreciation for that current year is an expense. The depreciation for that current year is an expense in the business. Now, let's move on. Let's move on from there. So we have said provision for depreciation and provision for bad debts. Before we move to preparing the accounts, let's also understand what is a bad debt. So we have what we call bad debts. If you're talking about bad debts, what are these? So the bad debts, if we are looking at the bad debts, these are customers whom we feel or whom we think are not going to pay us. There should be a substantial reason why you think so. So my bad debts, you're saying these ones are not going to pay us. There is evidence that has shown that these are not going to pay us. Maybe the person was owing us and they've been declared bankrupt by the state. So if someone is declared bankrupt, we are saying they are no longer able to pay mari ari kukwereta, eni zvikweretu zvese zvaanenge ainazvo haasisina ma-assets anokwanisa kubhadhara. If they have been declared bankrupt, hatirambe tichitarisira kuti once this person makes a payment, we're going to use the money. So once someone has been declared bankrupt, they are now a bad debt, and we write the bad debts off our books. So for accounts, once you there is evidence that the customer is not going to pay you, you don't keep recording them, you need to write them off. So the bad debts, these are the credit customers. That's the company these are the credit customers that the company has written off because they won't be able to pay. The amount due. So the company has written them off because there's evidence that they are not capable of paying the amount due. So they are not capable of paying the amount due. So that's depreciation and bad debts. Bad debts are also expenses. So bad debts are expenses to the business. So the bad debts, they also fall under the bracket of expenses to the business. The bad debts are also regarded as expenses to the business. Okay, now let's move on. So now let's talk about the term provision. So there's provision for bad debts and provision for depreciation. So a provision is an estimated amount. So if we are talking about a provision in accounts, they can ask you that. A provision, this is an amount we are estimating. We are not yet sure whether this person is not going to pay. There is a high chance they are not going to pay. What if this person wins a lotto and after they've been declared bankrupt? There's still a possibility, but there's now a very low chance. So we write someone as a bad debt. Why do we call it a provision? If it's a provision for bad debts, this is an estimate for those that are not going to pay. So we can say provisions are estimates. Provisions, these are estimated amounts. These are estimated amounts. If you're talking about provisions, these are estimated amounts. You're not yet sure. Okay, let's go to our module briefly and check what we are supposed to know about. So we are supposed to know about the methods of depreciation. So we're going to talk about that. Then disposal of fixed assets. We're going to talk about that. Provision for depreciation. Okay, so let's start with that. So methods of depreciation. Methods of depreciation. So we have said that as we use up the asset, it's likely to reduce in value. If you buy a motor vehicle, you buy a machine, the more you use it, it's likely going to reduce in value. So the value by which the asset has dropped is the depreciation. But how do you calculate the depreciation? What methods can we use to determine the value of the asset? So the first method we can talk about is the straight line method. So the first method, we have the straight line method. So if you're accounting for depreciation, the first method, we can talk about the straight line method. And what is the straight line method? Or what is the assumption behind the straight line method? So this method assumes that the depreciation is the same each year. The company, if the assets of the company are losing value, they lose the value by the same amount each year. So the straight line method, it assumes a constant. This method assumes a constant depreciation. Each year. That is, the company reduces value by the same amount. The company reduces value by the same amount each year. That's the assumption of the straight line. If you buy an asset today, it's going to reduce value, yes, but the straight line says it reduces value by the same amount each year. If you are to buy an asset, let's say, at a cost of, you buy an asset at a cost of 40,000, and you are expecting to use that asset for a period of 10 years. So the straight line says the asset is going to reduce value by the same amount. So the depreciation each year will be, if you buy it for 40,000 and you're expecting to use it for 10 years. So it assumes the asset will be losing value by 4,000 each year. So the asset is going to be losing value by the same amount each year. Kusika 10 years zakwana. So that is the straight line method. Assume kuti asset not on a value by the same amount each year. Okay, but however, there is a formula. So there are two formulas for the straight line. If the question it says calculate depreciation. So if the question says calculate depreciation using the straight line method, we can say the cost minus the provision times the percentage given. So, sorry. This is for the reducing balance. So for straight line, you're saying cost minus scrap value over number of years. Sorry for that. It's cost minus scrap value over the useful life. So calculating depreciation using the straight line method. You say the cost, that is the price at which you bought the asset, minus the scrap, it can be called the residual value. This is what you are expecting to sell the asset for. The cost is the price you bought the asset at. The scrap value, the asset. Over the useful life, this is the period the asset. So if it's the straight line method, we would say the cost, that's the price you bought the asset at, minus the scrap value. Scrap value, this one, no price the asset. Useful life, that's for how long do you think you're going to use the asset? That's the first formula. So, formula number 2, or depreciation. If it's a straight line, you can also say depreciation is the cost times the percentage given. So again, it's straight line. If you're given the cost and the percentage of depreciation, if the asset is being depreciated on cost, it is the straight line method. If the asset is being depreciated on cost, if they say the asset is being depreciated on cost, it's the straight line method. So if the depreciation is on cost, it means that is the straight line method. So let's have example one. KD acquired a motor vehicle on 1 January. Acquired a motor vehicle on 1 January 2020 for 50,000. It was expected to be used for 20 years and then disposed and then disposed for 4,000 and then disposed for 4,000. What is the depreciation? For each year? What is the depreciation for each year? So depreciation yedu teda unoti using the first formula at now pure percentage announce on cost and it so depreciation yedu tuenda tunochansa the first formula cost yatakatenga nayo 50,000 minus the scrap value ndo mari yatirikutasira kutengesa nayo in the end that's 4,000. So the cost minus the scrap value divided by the useful life. We are expecting to use this asset for a period of 20 years because of the 10 years, so you divide by 20. So the useful life is the period that the asset for. So depreciation you do 2.3. So for straight lines, you know out every year, kuska asset it's depreciating by 2.3. It's depreciating by 2.3. Let's move on. Method number 2. So the first method A, that is the straight line. The second method is called the reducing balance method. The second method is called the reducing balance method. So under this method, so for the straight line, that is the asset, straight line, that is the asset depreciate with the same amount. But for the reducing balance method, this assumes that the asset loses value. The asset loses value by a greater amount when it is still new than when it is now old. So under the reducing balance method, the assumption is if the asset is still new, it loses value by a very big proportion. So an asset reduces value by a very large proportion kana richirinywa. Then as the asset grows old, value inenge ichidona but haichadone the same way yanga ichidona nayo paranga rinywa. That's the assumption of the reducing balance method. That's the assumption of the reducing balance method. Now let's move on. So for reducing balance method, the formula, we say cost minus provision times the percentage given. Cost minus provision times percentage given. That's the reducing balance method. Cost minus provision times the percentage given. Let's have an example, or let's copy that same example and modify it. So for the reducing balance method now, we are going to remove the statement from here and rewrite it over that. So Katie acquired a motor vehicle on 1 January 2020. The vehicle was later disposed. On, we can say it was later disposed on 1 January 20, we can say 31 December 2023, or rather, let's say 2024. It was disposed on 31 December 2024. For 46,000. It was sold for 46,000. Then to the company's policy is to depreciate. The company's policy is to depreciate all motor vehicles. To depreciate all motor vehicles at 10% using the reducing balance method. To depreciate all motor vehicles at 10% using the reducing balance method. Then the first question, or rather the question says, calculate the depreciation of the asset from the day it was bought up to the day it was sold. So required calculate the depreciation of the asset from the day it was bought up to the day it was sold. So calculate the depreciation of the asset from the day it was bought up to the day it was sold. Calculate the depreciation from the day it was bought up to the day it was sold. So how then do we work it out? So remember our formula. We've said the depreciation is equals to, we've said depreciation is equals to cost minus provision times the percentage given. The cost minus the provision times the percentage given. So we bought this asset in the year 2020. That's the first year. So we want to calculate depreciation, not just for 1 year, but from the day we bought it. So that one, how much is the depreciation for 2020, for 2021, for 2022, and up to for 2024. So we are going to calculate depreciation for each year. So please pay attention to how we do it. So in the first year, cost year is 50,000 minus provision in depreciation yata calculator kumashure. In the first year, the provision will be 0 because trinket starter calculator any depreciation. So you then say times the percentage that said that the depreciation was at 10%. So in the first year, they're saying 50,000 minus 0 times 10%, that would be 5,000. So that's our depreciation for the first year. That's the depreciation for the first year. Then for the second year, that's 2021. You say the cost 50,000 minus you actually have the provision in the second year. My depreciation at a calculator for the years of my shooting. So in the year 2021, provision is the depreciation, total depreciation for the years of my shooting. So it would be 5,000. So you remove the total depreciation of the previous years, then you multiply by the percentage. So that's 50,000 minus 5,000, that's 45,000 times 10%. Move on to the next year, year 2022. We start again with the cost, the 50,000 minus the provision through Edama depreciation at a calculator. So far, the calculator 5,000 plus 4.5, scatter calculator 9.5. The total of my depreciation at a calculator so far, that's the provision, so times 10%. So that's 50,000 minus 9.5 times 10%. So that's for year 2022. You do the same for year 2023. So we do the same for year 2023. It's 50,000 minus the total of my depreciation that we've calculated. So we are taking the last total, which was 9.5, and we are adding 4,050. So it means the new total is 13,550. 13,550. So that would be 50,000 minus 13,550 times 10%. So we repeat the same for 2024. You can quickly try for 2024, then we do it together. So for 2024, it would be what? Quickly do that one. Quickly complete for 2024. So let's now do it together. So for 2024, it will be 50,000 minus the total of the previous year depreciation. So the total, it would be the last total, the 18,550 plus the last year depreciation, 3645. So it means 17,195. Say times 10%. So this would mean our depreciation is 50,000 minus 17,195 times 10%. So this is the total depreciation for each year. We've been calculating the depreciation for each year up to the time the asset was sold. So Pazutengeso asset, it had depreciated by a total of how much? So the total depreciation, it means the total depreciation of the asset from the day it was bought up to the time it was sold is 20,470. 20,475. Okay, now let's move on. So those are the two methods of depreciation that we want to look at. So the reducing balance method and the straight line method. However, there are other methods, but the key ones is the reducing balance and the straight line method. So after the depreciation methods, we need to know how to prepare what we call an asset account. So when an asset is acquired, the company creates an asset account. When we buy an asset, we create an asset account. So let's have our asset account. So asset account. So for asset account, we start with the balance BD. So the balance BD is the opening balance. The balance BD, these are the assets we had at the start of the year. Kanadatanga Goretine Manguma assets. The assets we have at the start of the year, no balance BD. If we buy more assets, no assets at now. So if we buy more assets, we are going to debit in the asset account. So asset account, we are recording my assets at now. No assets. If we buy more assets, we debit the asset account to show that my assets and business are with there. So if we buy using money in the bank, we debit the bank. So kana tikatenga assets using money in the bank, we debit the bank. If you buy using cash, you debit cash. So we debit the bank or cash. So you debit the bank or cash. Then on the credit side, tunaita disposal. Disposal, these are the assets we sold. On the credit side, tunaita the disposal. In fact, the asset account, it can be prepared. This one is an asset account at cost. So the balance BD, that's the cost of assets we had at the start of the period. The bank, that's the cost of asset we acquired. Disposal is the asset we sold at its cost. I'll give you an example. Then after that, you come up with your closing balance. That's the balance CD. Come up with your closing balance for the assets. So asset account at cost. So let's move on. So from the asset account at cost, we also need to know the format for what we call the provision for depreciation account. I'll just give you the formats, then we can have an example. So the provision for depreciation account. Provision for depreciation account. So the provision for depreciation account, it starts with the balance on the credit side. Balance BD of the provision for depreciation account is on the credit side. So the balance BD is on the credit side. Then this side we put disposal. What is disposal? It's the depreciation of the asset we sold from the day it was bought. So disposal. So the disposal is the total depreciation. Is the total depreciation of the asset sold from the day it was bought. The total depreciation of the asset sold from the day it was acquired. So we have the balance BD on the debit, we have the balance CD. We have the balance CD, then we have what we call the profit and loss. So that's the layout for the provision for depreciation account. Let's have the layout first, then we'll later discuss how we can calculate the amount. So that's the provision for depreciation. Provision for depreciation, then besides the provision for depreciation, besides the provision for depreciation, we have also what we call the disposal account. Disposal account. Disposal account. So the disposal account is prepared whenever we sell assets. So we'll do an example to show when do we how we use these accounts. But disposal account is used to determine, but I think it's an asset. Did we gain or did we make a loss? So it's used to determine whether there was a profit or there was a loss when you sold the asset. So the disposal account is used to determine the gain or loss on disposal. We start with the cost on the debit. That's the cost of the asset we have sold. I'll just put a random amounts there. The cost of the asset we bought, sorry, we have sold. Takanga taritenga nemari. We have sold it, but at what price had we bought this asset? That's the cost. Then there's a depreciation, they say. Depreciation is the total depreciation of the asset. Kubva patakaritenga usika tiritengese ranga rareduce value nemari. That's the depreciation. Then besides the depreciation, we have the bank or cash. Ndo mari yatakatengesa nayo. The bank or cash. That's the price yatakatengesa nayo the asset. Difference ikabudira ku debit side, kano, we call it a profit on sale. Ikabudira ku credit, it's a loss on sale. Let's balance the account. Side taking the difference. So 3412 plus 14, that's 26. So it means side iki is the credit side. When you're at total then side iki, you put your balance. In this case, that difference is a loss on disposal. Or this one, a loss on disposal or loss on sale. So this would be a balancing figure. The loss would be a balancing figure. Okay, so accounting for depreciation, we're here. So example one, lorry was bought. This is now a module. A lorry was bought and will be kept for 4 years and sold for 2,000. So you say this is the straight line method. So for the straight line method, we're just taking the cost. We divide our cost minus the cost minus the residual value over the number of years. But this is not what I want. I want us to look for a question that can, so disposal, provision for depreciation. I've given you those accounts. Yes. Now I want you to read this question. This example 11.1. We are going to do that one together. So we're going to do example 11.1 together. Okay, so a business financial year ends 31 December. A motor vehicle was bought on 1 January 2008 for 4,000 and was estimated to be worth 1.4. At the end of its useful life, after 3 years, the asset was sold for 1,400. Show number one, the asset account. Those, if you can take a peek for the question, please do so that when I leave the screen, you can be able to get those amounts. Okay, now we can now go to our Excel. And now go to our Excel. Oh, you're still copying. Can you copy first? We finish up from the. Okay, so let's now go to our Excel and apply. So the question was saying, come up with the asset account. So the asset account, show that this format works. I will just copy this. The question was, however, to simplify that some of the things on this account are not there. So the balance BD, these are the assets, the value of the assets we had at the start of the year. The asset was bought in 2008. So we start from 2008. That's the first year. So we start with the year 2008. So in the year 2008, we were not told that we are not told that there were any assets in the business. So the balance BD is 0. Then in the year 2008, that's when we bought. If you read the question, in the year 2008, that's when we bought an asset for 4,000. So you would put that here. The asset you bought during that year, you put it under that. Did we sell anything in 2008? No asset was sold, so there is no disposal in 2008. Then you calculate your balance CD. So your balance CD if there was any amount on the debit here, you'd add this plus this one. Then the bigger total is what you bring here. Then the balance CD, you'd say the 4,000 minus any amount that was on the for disposal. So the balance CD is what we bring down to be the balance BD. So the balance CD is the balance BD next year. So this would be the year 2000. This was 2008. So the balance BD will be in the year 2009. So in the year 2009, the balance BD would be 4,000. So in the year 2009, the balance BD would be 4,000. You can still continue with the account, but since there are no other assets which were bought, it will just be continuing with the same amount. Like the balance BD, then in the year 2009, nothing was bought. So for bank, it's 0. Then nothing was disposed. So for disposal, it's again 0. It's 0. Then the balance CD. We then calculate our balance CD. So for balance CD, that's 4,000 plus 0, that's 4,000. 4,000 plus 0, that's 4,000. Then the balance here is 4,000. Balancing figure, it becomes 4,000. Because we're only given 4,000, it's the one that will keep repeating. Let's do for the last year because they said the asset stayed in the business for 3 years. So for the last year, that is in 2010, the CD, the balance CD is the balance BD in 2010. Then in 2010, did we sell? Yes, we sold. That's the year we sold the asset. So there is disposal. Did we buy anything for bank? No, we don't have a bank. So we don't have bank. Disposal, tunoisa mari yatakatenga nayo the asset. But disposal, hausvisa mari yautengesa nayo, but the amount yawanga watenga nayo the asset. Then if there is a difference, you put your balance CD. But for the year 2010, the debit and the credit, they are equal. So canonical accounts, if the debit is equal to the credit, we don't have a balance sheet. So in this case, the debit and the credit are equal. We no longer have a balance. So this is the asset account. That's for the asset account. Okay, then besides the asset account, the question had said prepare the provision for depreciation account. So provision for depreciation account. Please pay attention to how we prepare it if it's for different years. Provision for depreciation account. So if you're preparing provision for depreciation account for more than 1 year, the first year provision yatatanga nayo is the balance BD on the credit. But for the first year, it's in a balance BD. The balance BD provision for the years of Mashure, of which this is our first year, that's 2000, the first year, that's 2008. So after the balance BD, next, tinoisa tatum provision for depreciation account. After balance BD, shares a profit and loss. Shares a profit and loss. Then this side it shares a disposal. Disposal inoiswa gore ratatengesa. The first year hatina kutengesa anything 2008. Gore ratatengesa ndo patinoisa disposal. Inenge yakamirira chii? Tanyora tikati disposal inenge yakamirira the total depreciation of the asset sold that year. Then the other issue yatisina kumention apo is the profit and loss. Profit and loss is the depreciation for that year. So takatenga asset 2008, ndovaragara 2008, ndovaragara 2009, ndovaranzi futi 2010, ndoparakazotengeswa. So depreciation asset for the 3 years. Ya 2008, ndo yatinonyora panzi profit and loss in 2008. 2009, depreciation yacho futi ndo yatinonyora panzi profit and loss. So for profit and loss, tikuisa depreciation yegore iroro. So, and it no a question about how were we depreciating the asset? So depreciation is on cost. The question is saying on cost, but I would want you to twist it. Can we say using the reducing balance method to make the question more interesting? Because the cost is straight line, it's also the same amount of depreciation. So can you twist and assume the question had said 20% using the reducing balance method? Let's twist it and say 20% using the reducing balance method. Or we will do it for now. Let's use the reducing balance. Then the next, then we'll do it also using the straight line so that you notice the difference. So using the reducing balance method, you can start with, let's start with calculating the depreciation. So 30, the first year is the cost minus provision, of which the provision for the first year is 0, times the percentage given. The question had said the depreciation is at 20%. So on the first year is just the 4,000 times the 20%. Second year, 2009, if it's the reducing balance method, we are saying 4,000 minus the 800 given times the percentage, which is 20%. So that would be, that's 4,000 so that's 4,000 minus 800 times 20%. Move to the next one, that's 4,000 minus the total now, or you can simply say minus 800 minus 640. So you remove the total of the previous year depreciations. Then we multiply that by 20%. So these are the depreciations for each year. The profit and loss. If you are preparing the provision for depreciation account, the profit and loss amount is the depreciation for that year. The profit and loss is the depreciation for that year. So it means in the first year, 2008, our profit and loss amount is going to be, we are going to put 800. So in the first year, 2008, for profit and loss, Chinese are 800. after putting the 800, we close the account. We close the account. So we close the account, 800, then the balance CD. So the balance CD, that's 800 there. So the balance CD is the balancing figure. Sure, by now we have an idea on balancing a T account. Then the CD becomes the balance BD next period. So the 800, we bring it down to become the balance BD next period. So always the CD for this year is the BD next year. So the first year it was 2008. Now we are in the year 2009. Now we are in the year 2009. So in the year 2009, the profit and loss figure is the depreciation for that year, 640. The profit and loss figure is the depreciation for that year, which is 640. Profit and loss is the depreciation for that year, which is 640. Then we did not sell anything in 2009, so disposal again is 0. Disposal is only put in the year we sold the asset. So we have balance CD. Balance CD, that's 1440. That's our balance CD. So CD becomes the balance BD. Now we're in the year 2010. Now we are in the year 2010. The year 2010, the depreciation for that year is the profit and loss. The depreciation for that year, we had not recorded as the profit and loss. So in this case, it's 512. So the depreciation for this year is 512. Depreciation for that year is 512. Depreciation is 512. Then let's have the balance CD. Oh, in the year 2010, that's when we sold. In the year that we sold, tunaisa disposal. If we sold in that year, tunaisa disposal. And how much is your disposal? The disposal is the total depreciation of the asset we have sold from the day it was bought. The total depreciation of the asset sold from the day it was bought. So we're adding the depreciation, the total depreciation from the day it was bought. That's disposal. That's the total. So if we add these, again, in the last year, we don't have any balance CD because the debit and the credit are the same. So disposal, is in the year we sold the asset. And the disposal is the total depreciation of the asset sold. Disposal is the total depreciation of the asset sold. Disposal is the total depreciation of the asset sold. Now, Let's repeat the procedure, assuming it's straight line. So our data with the reducing balance method. Now we want to do it. So let's indicate, maybe let's indicate somewhere that so assuming the reducing balance method at 20%. So this one, we are now assuming the straight line method. Straight line is much simpler. Straight line method or on cost or depreciating on cost. If it's the straight line method or depreciating on cost, how do you find the depreciation? So remember, or let me remove these amounts now. I'll just leave the format without these amounts. So we have 2008, 2009, 2008, 2009, 2010. 2008, 2009, and 2010. So for 2008, the depreciation for 2008, the depreciation for 2008, if it's on cost, you are taking the amount you take a nayo, that's 4,000. You multiply that the cost. So the difference is, if it's the straight line, the depreciation does not change. So the amount you have calculated for the first year is the same throughout. Unlike the reducing balance method, if it's the straight line method, the depreciation is the same for all the years. So the depreciation is the same for all the years. Yes. Mm. All right. So if it's the straight line, we have said Canada to a cost. If we go up, we said we can say cost times the percentage given. So the cost of the asset, it was 4,000, and the percent was 20%. Okay, then, so for the first year, remember profit and loss triggers are the depreciation for that year. So we said the 800. The difference is for reducing balance, it was changing, but ABA is the same throughout. So the depreciation for the reducing balance was changing, but for the straight line, the same. So take note, the balance CD is the balance BT here. Then for the profit and loss, you put the depreciation for the year, the 800. Then we move, that's 800 plus the 800. the balance CD. So for the balance CD, this side is only 1.6. So that becomes our balance CD. The CD becomes the BD. The CD becomes the BD. The CD becomes the BD. Then lastly, we have the 800. This year, disposal, we sold in the year 2010. Disposal is the total depreciation. $800 plus 800 plus 800. So the disposal is 2.4. So again, the debit and the credit can againzana, we don't have any balance. Then now let's talk about the disposal account. So let's prepare the disposal account. To say it, this is the layout. So you can copy that and show that the format works. So this is the layout. I'll just remove the amounts. So the difference can be on the debit, it can be on the credit. So if the difference is this side, it's a profit on sale. If the difference is on the debit, it's a profit on sale. If it's on the credit, it's a loss on sale. So the difference can either be a profit on sale or it can be a loss on sale. The difference can be a profit on sale or it can be a loss on sale. Okay, so let's start with the cost. So the cost is given as 4,000. The cost is 4,000. Let's start with the easier ones. The cost to be given, the asset. So the asset we have sold was bought, we have been dealing with, at 4,000. Then bank or cash no mari yatakatengeswa nayo. If we read the question, at what price did we dispose of that asset? It was sold for 1.4. So it was sold for 1.4. It was sold for 1.4. So if it was sold for 1.4, that's the bank or cash. Then the depreciation is the total depreciation of the asset from the day it was bought. The depreciation depends now with whether we used the straight line or we use the reducing balance. So if using the straight line method, it means the total of the depreciation is what we would put here. So if it is the straight line, we would take the 2.4. If it's the straight line, we would take that 2.4. Now let's balance off the account. Which side is bigger? 2.4 and 1.4. This side is smaller. So 4,000 again is bigger. So we put 4,000 both sides. The difference is the loss. The difference is the loss on sale. So there's a loss on sale or loss on disposal of 200. There's a loss on sale or loss on disposal of 200. Loss on sale or loss on disposal of 200. Okay, so if you check, that is their answer. So our asset account, this is the that's so we have prepared the asset account. Now I've done this with you so that when you are now revising, you can go and refer back. I think for the provision, they have used the straight line only, but we have used both the straight line and the reducing balance. The disposal account, that's the same account we prepared. Okay, they can ask us again for the, let's just use the answer that they've given us here. They can ask us the effect in the profit and loss. So in the profit and loss, we only show the expense. Those amounts we were writing profit and loss, those are the amounts we record in the profit and loss. The depreciation we calculated. So if it's the straight line, it means in the profit and loss, you'll be writing depreciation expense of 800, 800. You'll be writing 800, 800. In 2010, you write depreciation of 800, but there is a loss on sale. So that loss on sale, I'm thinking for the calculation, there's actually an error here. The profit and loss is the straight line. The expense is not going to change. In fact, the expense for 2010 is going to be higher. There's going to be the depreciation expense of 800 plus the loss on disposal, because loss on disposal is an expense. So can we add that to your notes, that loss on disposal is an expense? So there are quite a number of errors in the module that you also need to take note of. So the loss on disposal is an expense. So it means, I would say in 2000, for the year 2008, you'd record depreciation. If it's the straight line method, you'd record depreciation of 800. Okay, here we can say straight line. Here we can say, let's assume if it's the reducing balance. So if it's the straight line, decide if it's the reducing balance. So 2008, 800. If it's the reducing balance, would record 800 as well. First year is the same, but 2009, for straight line, it remains 800. But for reducing balance method, 2009, it has changed. It's now 640. In 2010, would record the depreciation. Again, straight line, it's 800. reducing balance, it will be now 512. But in the year 2010, there is also an additional expense loss on sale. If we use the straight line, the loss on sale, we calculated it to be 200. It increases our expense. Then the reducing balance method we had not calculated. So using the reducing balance method, maybe let's just copy that and come up with our disposal quickly using the reducing balance method. So the disposal using the reducing balance method. So the reducing balance method. Using the reducing balance method, chatinongo chinja is the depreciation. So for the depreciation, that it is the total depreciation. So reducing balance method, the total depreciation was 1952. Total depreciation was 1952. So our loss would increase to 648. The loss would increase to 648. Let's confirm. Yes. It would increase to 648. So this is the impact in the profit and loss. So these are the expenses we will record in the profit and loss. Now, let's look at the effect in the statement of financial position or balance sheet. Statement of financial position. So in the statement of financial position, the first year, what was the name of our asset, by the way? So a business, a motor vehicle is the asset. So in the statement of financial position, you have your non-current assets. We have a section for non-current assets, or we can call them fixed assets. Those that stay in the business for a long time. So we have a section for non-current assets. So for non-current assets, under the section for non-current assets, we can then start with, so under the section for non-current assets, we can then start with the motor vehicle. In this case, we just want to show an extract. Don't go at the effect. Don't go at the effect of balance sheet. So my non-current assets, first year, kuti tatenga asset it. All right, so the first year, which is, so you can indicate 2009. So in the first year, 2009, we bought the asset at 4,000. We removed the depreciation. So we are going to have that's 4,000 minus the 800. So first year, this is what we call the net book value or the carrying amount. So that's the carrying amount of the asset or the net book value. So the asset is said to have a carrying amount of 3.2 at the end of the first year. Then second year, in the year 2010, sorry, 2000, I was supposed to start with 2008, that's the first year. Then 2009, that's the second year. So in the year 2009, again, under non-current assets, you record your motor vehicle. So in the year 2009, the motor vehicle, you say the 4,000 minus. So you remove the total. If you are moving in the balance sheet, you can remove the total depreciation. So by 2009, asset nera depreciator, the 800, the 800, if it's the straight line. So it means nera depreciator by 1.6. So the book value saying 4,000 minus the total depreciation of that asset. So its book value would be 2.4. 2010, the year we sold the asset. Motor vehicle, and say that's the 4,000 minus. So the 4,000 minus the total depreciation. So it was 800, 800. So this year, the total depreciation will be 2.4. So the carrying amount in the year 2010, 4,000 minus 2.4. So these are the carrying amounts. These are the carrying amounts. These are the carrying amounts. Now, let's move on. Now we are getting to the provisions. So I think now you have those questions to attempt. You have those questions to attempt. I think now we want to talk about bad debts and doubtful debts. So subheading bad debts and doubtful debts. Bad debts and doubtful debts. So bad debts and doubtful debts. Can call them bad debts written off and provision for bad debts. Bad debts written off and the provision for bad debts. So we have those that we have written off, and we also have a provision for bad debts. So I have the bad debts written off and the provision for bad debts. So the bad debts written off and the provision for bad debts. So let's understand first the difference. Started bad debts, these are the customers whom we think they're not able to pay us. And we are saying the conditions present are showing good, they are not able to pay. So those are bad debts. We are not expecting to receive my Then these bad debts, Canadians, they are written off. It means we are sure our vachabadara. My conditions are no, our vachabadara. But there is a provision for bad debts. This is an estimate. My standards edu anoti, once ukangowane vanhu vari kukukwereta, you should always create an estimate. Yevachatadza kubhadhara. Pane wavati vavashoulder vavachabhadhara, those are bad debts. Then you should create an estimate always yevanhu vanogona kutadza kubhadhara. So we can say the bad debts written off are the debts the company has confirmed will not be able to pay. But the provision for bad debts is an estimate made from the current data. So from those vatiri kutarisirwa kuti vachabhadhara, we always create an estimate yevachatadza. Pane vatiri sure kuti ava vachabhadhara, those are debtors. Then we need to create always an estimate yevanhu vachatadza kubhadhara. That's the provision for debtors. It's an estimate of those that will fail to pay. So the provision for bad debts, it's an estimate of those that will fail to pay. So we've mentioned that the bad debts are an expense. So we can say the bad debts written off are treated as expenses. But for the provision now, the provision for bad debts, that estimate, it can either be an increase or it can be a decrease. So you can say the provision for bad debts, the provision for bad debts, the provision for bad debts can either be an increase or a decrease. It can either be an increase or a decrease. The provision for bad debts, if it is an increase, we treat it as an expense. If it is an increase, we treat it as an expense. If the provision for bad debts is an increase, we treat it as an expense. What if it's a decrease? If the provision is a decrease, we treat it as an income. If it's an increase, we treat it as an expense. If it is a decrease, we treat it as an income. Then you also come across the term bad debts recovered. Bad debts recovered. These are debtors who have been previously written off. But they have paid the amount they were owed. So Tata write off this person, they are not able to pay us. And suddenly, Ava win a lotto. So we had written off this person saying we are not able to pay, but suddenly, Ava wana mara also to pay. So that one is called a bad debt recovery. So this is a bad debt previously written off, but now it has been recovered. So for today, I want us to end here. Totangira up, refresh, preparing the accounts for the bad debts written off and provision for bad debts. So for now, we can go and recap the asset account, the depreciation, the disposal accounts.